Hello, welcome back to the continuing lecture in investment analysis. Um, so we're now moving on to the capm and APT. Now, capm is, already the topic that was discussed uh, also in Finance 100, which stands for Capital Asset Pricing Model. And we pretty much, understand. You already learned the basic, structure and the equation of CAPM. Now we need to, but as in all regression models, CAPM is basically a regression model. But as in all regression models, there are constraints. I mean, regression models all assume certain, uh, uh, assumptions are met, basically, and if those assumptions are violated, then, you can't really, um, uh, you can't really, take the regression results as reliable and robust. But anyway, so let's take a look at these, further assumptions and, uh, uh, what CAPM is, uh, how it relates to the index model, because we already in the last chapter we already discussed index model. Actually, the index model was not there first. Actually, chronologically, historically, CAPM was developed first, and then index model came about. Uh, so, in a way, it's a little, logical. To me, it was a logical mystery when I was a graduate student, when I was a doctoral student. It looks like CAPM makes perfect sense when it is expressed in, index model format. So it looked like, and CAPM index model was actually, from index model, then to me, it seemed more natural that the just by, transposing the, I mean, from excess return, regression of excess return versus, excess return, right? If you move the RF to the right-hand side, then it becomes CAPM. So I thought that was a naturally the case, but, actually it was the other way around. They got to CAPM first, and then index model. So we already understand what market portfolio is. And of course, you cannot exactly replicate, S&P 500 exactly in its entirety. I mean, the market portfolio we can have is a scaled down version of, S&P 500, of course, to have S&P real S&P 500, you would have to have, trillions of dollars, tens of trillions of dollars, uh, but each security, so it's a scaled down version of S&P 500, right? And each security held in proportion to market value of, so if GM is 20%, or General Electric, maybe, not GM, is 20% of S&P 500, then your market portfolio would exactly replicate. I mean, scale down, if it is a scale down version, let's say your portfolio size is, $1 million, and then 20% would be, GE or something like that, right? Exactly in that proportion. And we already understand what index model is. We know as a firm-specific excess return, firm-specific return, not excess return. RI is the excess return, RM is the market excess return, Alpha is the abnormal return, right, from specific and um, error term. It's called eta or epsilon or eta. I think epsilon is a zero mean noise, white noise. White noise meaning um, uh, the mean of the error terms, the noise, is zero, right? Or firm specific risk or residual firm specific residuals or error terms. And expected risk premium, given market risk premium, this conditional to or given, means it can be perfectly explained by beta and alpha, right? However, eventually alpha will become zero. Why? Now think about it. Just like in everything, when you know that there is a opportunity in something, right? Will that profit opportunity last forever? No, obviously it's not going to last forever, right? Because the window of opportunity will close eventually. When you know that there is alpha to be in Google, are you gonna just let it go? Are you just gonna let it? I mean, if you knew that Google has a significant alpha, then you will buy Google. It's not only you. Everyone else in the market will soon, as long as they do security analysis or they hear from someone who does security analysis, they will know there's a significant alpha in Google, and they will all run to buy Google. The demand for this positive alpha, there's an upward pressure in demand, right? I mean, a demand goes up for Google, and then there will be an upward pressure on price. Price will go up eventually. And if there is a negative alpha in Google, then they will all sell. So demand falls and the price will fall. And therefore, this increase in price or decrease in price will eventually push the alpha back to zero in the long run, right? When alpha is zero, the only way to earn expected return greater than T-bills is only by bearing the systematic risk, right? Beta. It comes only from beta, because alpha is zero. And mathematically, that is. That's why I love math. It makes it logically everything, quite self-evident, right? If alpha is zero due to this, then the only source of excess, earning, return greater than X, the only source of return is a beta, right? The best portfolio, therefore, that will reaffirm our understanding already that the passive strategy is not a bad strategy. Passive strategy is, I mean, you can have active strategy will yield extra return, while as long as there's window for alpha. But when that window closes in the long run, right, then eventually it will be a passive strategy, right? I mean, passive strategy will be a good strategy. Now, these are the assumptions for capm, and these, as you can see, these assumptions are very restrictive. Actually, to have a valid and robust regression, there are six constraints. If I remember correct, 5 to 6 constraints to regression. That those restrictions, constraints must be met. Have meaningful regression results. But first of all, for capm, market markets must be competitive and equally profitable, meaning, no investor will no investor is wealthy enough to affect prices. I mean, yeah, think about it. This assumption is already violated in reality. Why? Because large hedge funds, or I mean, large, institutional investors, they mobilize huge, funds to manipulate the price, and then they beat up the price, uh, and then when the price is uh, beat up, then they pull out, suddenly sell off everything. They they realize profit, they take profit, but then that pulls down everybody else. That pulls the market. Uh, But this is also, in economics, think about it, in uh, market structure and, microeconomics, market structure. First of all, there are contrast, uh, two extreme contrasts. What are those? In a market structure, there is a monopoly, there can be monopoly, and there can be perfect competition. And think about it, in a perfect competition, what does that mean? No seller, no producer is bigger than the other, significantly bigger than others. I mean, if any seller is significantly bigger than the other, uh, what happens? There can be no perfect competition, because if you significantly bigger one, first of all, has the advantage of economies of scale. Remember, I mean, large scale production would lower the production cost, right? Average, variable cost, average cost. I'm sorry, average cost. So it gives, price advantage, right? Or cost advantage, or cost advantage is eventually leading to price advantage, right? So then it cannot be a perfect competition, right? At the other end is the monopoly. Monopoly is, a huge giant seller or producer, and uh, no competitor, right? Of course, perfect monopoly is uh, just like, perfect competition is only a textbook concept, but there are natural monopolies. I mean, it may not be the uh, something that is, it may not be the perfect competition globally, but locally there are uh, monopolies, like utilities, utility companies. Utility is a natural monopoly, because you understand, uh, because there can be no competitor in terms of gas and power, because the infrastructure is already uh, laid down by that company. I mean, if you live in New York, Connecticut, Con Edison is your uh, and Northeast, New England. Con Edison is the power and gas utility, and uh, the only reason they are natural monopoly is because they own. I mean, they are the ones who lay down all these, gas pipes, pipelines, and um, power lines, and there can be no, if there were to be a competitor, then the competitor must also uh, lay down, pipelines, power cables. That's too much investment, too much cost for uh, uh, too much cost for benefit, because how many of the existing, Con Edison customers will switch to? I mean, even if half of them switch to the new company, right? Um, it's like, you have to make this gas and power uh, available to every home and every commercial building, It's like two power cables are going into and two gas lines are all going into the single home. And that's even if 50% of the current customers switch, that won't justify the cost. I mean, both companies, Con Edison and uh, the other, the competitor, will both fail. Make sense, right? Um, because of for the cost, they cannot. Um, uh, and besides, that's called, double investment. Investing in those, infrastructure. I mean, it's useless. It's completely. There will be completely idling, infrastructure that will not serve any uh, purpose. Makes sense. Um, and actually, it's not only the like it is, even cable TV. Look at the cable TV, all right? Um, Usually, it's regional monopoly, regional, right? Because if your area is served by Time Warner, it's Time Warner because no houses, no buildings, residential or commercial, they cannot be served by two cable lines because one cable line will abandoned, and that's a huge investment for the company. I mean, if their uh, cable is uh, uh, not used, then their investment is the sunk cost is not recovered, right? The sunk cost for that infrastructure is not uh, and et cetera, et cetera. And also, like MTA, in New York City, subway is operated by MTA, and uh, uh, can there be a competitor laying down another subway structure? Think about it. It's going to be a hell, first of all, right? Think about Seventh Avenue being served by two different companies. Uh, the existing subway uh, infrastructure is owned by MTA, unless MTA allows another company to run on their current tracks. That's not gonna that's gonna be a hell because the competitor will have to dig up Seventh Avenue or Sixth Avenue or Fifth Avenue again. There's no space underground, even underground space, no underground space to lay down another structure, right? Makes sense. And digging up all that, that's not only gonna undermine the seismic stability of the geological and seismic stability of the New York City. uh, uh, I mean, there's no room. I mean, under Seventh Avenue or Eighth Avenue, there's no extra room to put down another railway tracks, right? If they do, it will have to uh, damage uh, the substructure of the existing buildings, or the underground infrastructure like gas lines, pipelines, water main, et cetera, et cetera, and like disruption in traffic and life, that's going to be a life business and everything. uh, they will not, it's unthinkable, right? It's not going to. But, MTA is a perfect example of, monopoly, right? So, but, uh, just like that, and if public, can you imagine public transit uh, to be in perfect competition? Come on, right? Subways, perfect competition. There will be thousands of companies running subways. That's something cool, right? Uh, but monopoly. That's why natural monopoly is already uh, a difficult thing because the company has to have huge capital, right? Company must be able to supply that huge capital uh, to build that infrastructure, and the company also has to have the technological capability to operate and manage that system, right? But just like perfect competition, and also all investors be pretty much about same uh, size, so that they cannot. No one investor is significantly wealthier than others to affect the prices. And one B, all information is publicly available. This is also an assumption that is in reality violated because some investors have privileged information, right? And obviously, that privileged information or private information, that's what makes. Actually, Chapter 8 is about we don't have, actually, I can do this online because, I can put the lecture, complete lecture on YouTube, uh, aside from the actual college course, because given one semester, which is at best 15 weeks and 3 hours per semester, we can't possibly cover everything, right? So I can put up the lecture, the recorded video, lecture video uh, on YouTube about the efficient market about efficient market hypothesis, which is nothing. Basically, what it means is information is a market price uh, reflects all uh, uh, public information immediately. The price information is efficient, right? Price reflects all but even that market efficient market hypothesis, still it allows for um, private information, because private information is not public. Prices can reflect only public information. Uh, but if there is no uh, private or privileged information, right? Nobody has any advantage, unfair advantage uh, over anybody else. So it's like perfect competition concept. Now, all securities are publicly owned and traded, yeah. And then no taxes on returns. Tax uh, is called frictionless market, frictionless trading. Tax is a friction. It's a friction, right? Transaction cost is friction. So these assumptions are like in a very idle universe. This assumption assumes ideal universe where there is no private information, no friction to trading, market transactions, right? Uh, and you can borrow and lend at unlimited, without any limit. You can borrow at risk-free rate, right? So these are very restrictive assumptions. It's not realistic. That means it's not realistic. But if uh, we can do a thought experiment of an ideal universe, everything is like this, and investors are all alike. Investors are all alike, except for initial wealth and risk aversion. Okay, initial wealth and risk aversion. Yeah. But once again, to satisfy assumption one, no investor is significantly wealthier than the others. But there will be slight differences in initial wealth, right? Uh, and of course, everyone would have different risk tolerance, risk aversion, right? That gives you the rationale, or that gives you the theoretical basis for capital allocation line, because along the capital allocation line, you can have different combination of standard deviation and return, but still uh, uh, staying on the same Sharpe ratio, right? CAL. Now, investors plan for a single period horizon. Also, I mean, multiple horizon model can be an extension. You can extend this period, to multiple. Rational. All investors are rational, mean variance optimizers. Yeah, rationality means always. Uh, Rationality is easy. I mean, it's not a difficult concept. Rationality. It's intuitively and logically obvious. Um, Everyone does more to less, right? Bigger to small. That's rational. Uh, Also, everyone is only rational to pursue maximum Sharpe ratio. In other words, highest mean return risk ratio. Right? I don't want to. If my benefit is, I mean, I invest $1 million, and if my return is less than $1 million, then that's anybody is stupid. Anybody can tell, right? If you invest 1 million, then getting a 1.5 million, or 2 million, 3 million, this return risk ratio being greater than 1, this is rational. Makes sense? The higher the ratio, that's human nature. I mean, some people, it's only human nature of any rational human being or sensible human being. Isn't that right? Even these common sense, sensibility, rationality, sometimes it's hard to find among people who just squandering their money, right? Money and resources. Money is not the only resource. Your time is also your resource. Your energy. So anyway, and then everyone uses the same inputs. Consider identical portfolio opportunity sets. In other words, if your main variance optimizers. So these assumptions, in reality, assumption one, category one, is relatively more restricted. Category two, generally, less restrictive, right? Now, and the capm is an equilibrium model, meaning that's what the return you can expect when the market for this particular asset stock is equilibrium. And all investors choose to hold a market portfolio, meaning, yeah, as a passive strategy, right? If all investors use mean variance analysis, right, apply to the same universe of securities, right, with an identical time horizon, use the same security analysis, and experience identical net returns from the same securities, right, they almost arrive at the same determination of the optimal risky portfolio. So, oops. So, our passive market portfolio is on the efficient frontier, right? And this is something we've been doing, all through, chapters, 5 and 6. Optimal risky portfolio is tangent on the capital allocation line. It makes capital market line. Capital market line is basically, CAL of the market portfolio. It runs from risk-free return through that tangency point. It makes CML the best attainable capital allocation line. Yeah. Okay, those are the theoretical, just theoretical background. So I will have to stop this video at this point and continue in the next video. Thank you for watching. I will see you guys in the next video. Stop.